So, as I mentioned, a lot to look forward to, but the main point definitely being the action taken by the Federal Reserve, where it has gone ahead and kept its key interest rate unchanged last night after having raised it for 10 straight times in order to combat high inflation. But in a surprise move, the Fed has also signaled that it may raise rates twice more this year, beginning as soon as maybe the next month. Remember, July 25th, 26th is when we're expecting the next policy meet, and perhaps that's when they could take that hawkish stance. Now, Fed's move has also left the benchmark rate at about 5.1%, and the commentary is what has really spooked the market, signaling that there is indeed going to be more tightening and it's not the end of that tightening cycle. Now, Wall Street did see that mixed move. We did see the S&P and Nasdaq then recover from those lows, but the Dow Jones did come under pressure, shedding somewhere 230 odd points. And likely that was a weaker handover that we saw. But the Asian markets also trying to push through that. And more importantly, here back home, we're just 132 points away from that all-time high for the Nifty 50. So can we make it through? We're going to be discussing all that and the implications of this Fed move with Peter McGuire, the CEO of XM Australia. He joins me. Thank you so much. Good morning, Peter, first of all, and thank you for speaking with us here at Money Control. Let's get your views straight out, the outcome from the FOMC on expected lines, but definitely that signal that has come from the commentary saying that we have to, feed in that expected another 2 hikes in this year. So is that what is going to keep everyone on edge now?
Well, good morning, Stacey. Yes, I truly believe it will keep traders on edge. It'll keep a lot of Wall Street having trying to second guess when is that first rate drop going to be, and it could well be, as you mentioned, towards the end of July, and then possibly that September-October period. We've just got to see how inflation is managed over this summer period in the US, and there's no doubt that 5.6% is where they're looking at for 2023. So that's where policymakers have lifted their median rate forecast. And we're just sitting here watching it all and the impact it has to markets.
Right. So let's get a sense of how much this is going to impact markets. You did tell us that, everyone's going to be on this wait and watch mode now to understand when that hike could be. But what is it telling us? We did see a positive number when it comes to inflation at 4%, which was some bit of a relief. So why is the Fed still playing hawkish, or why is this hawkish stance not really changing?
Well, I think, the 4% number, and it certainly was an improvement. There's no doubting that. So we can't argue with success. The other side of it, of course, is if that 2% is where they've got their mindset pretty much on, then, 4% is a big number compared to 2%. So that's why they're looking at, possibly further rate rises over this Northern Hemisphere summer / third and fourth quarter. And the impact naturally globally has got to be looked at. We're very thankful at the moment as far as cheaper energy prices. If they were, $20 or $30 dearer, then naturally that would have a great impact to Main Street and the cost of goods and naturally inflation.
Then what is this going to do for yields right now? Because those we saw definitely spiking. It was on expected lines, this outcome, this skip or pause. But is that going to change, and how are we going to see those react?
Well, yeah, naturally keeping a very close eye on yields. And, the other side of it is your 2-year, your 10-year, the cost of borrowing and what impact that has to home debt, retail sales, consumables. All of those data points need to be really examined over the next month or two, and how the consumer is being hit. So everyone says that the US consumer is very resilient. Well, that's going to be really tested this time through. And I think, over the next couple of quarters, we'll really see their resilience, whether they've got an appetite and a continuing spending power, or inflation has eaten away at their wallet and their purse as far as how much they've got left at each month.
Peter, also your views on crude. Now we've seen those really oscillate. There is now fear of the demand outcome, that outlook, as well as China, going back and cutting down its rates, and that being the biggest consumer. So how is that going to react, especially to this decision today?
Well, I think, Stacey, it's currently at 68.30 for WTI, and you've got $73.10 for Brent. Then it's been very soft, and we understand what the Saudi minister said going back about a week and a half ago, or maybe a fraction longer, before the OPEC meeting, that he didn't want to see shorts being a powerful tool for speculation on trying to drive prices cheaper. So again, Saudis came out with that 1 million barrel cut. If they don't see prices improve from here, I wouldn't be surprised that they look at a further cut sometime in that third quarter.
Right. And Peter, all of this data is what we've got. This whole week has been really data heavy. We are still expecting other central banks like the Bank of Japan as well as ECB to come out with their decision. And all of that is definitely going to have impact on the market. So let me understand from you, what are the other possible headwinds that we're likely to see for Indian markets as well as the others?
Well, naturally, I want to see what the central banks do if there is any movement at all as far as Japan. We're not really tipping any, but certainly 25 basis points for the ECB, and inflation is still quite high there. We've got recessions starting to bite in, or certainly recessionary fears in a number of European countries. And where we're looking at the euro at the moment, it's sitting around that 1.08 number. If they lift rates in Eurozone, I wouldn't be surprised to see that have a little bit of a further lift to the upside. And naturally, where India sits, it's geographically positioned between the two. And the other side, of course, is, you've got a strong domestic market, and they tell me that things are relatively strong as far as economically in India.
Well, that's what we are going to be looking at, how the macro really turns out for the markets as well. But thank you so much, Peter McGuire. They're the CEO of XM Australia, talking and breaking down what the Fed's decision really will be for the Indian markets as well as the global markets. Thanks so much, Peter.